The global economy is slowing, and we're seeing drastic measures to boost the economy back up. In this video, I'm going to share with you some data points that are indicating what we call red light signals, a slowing economy, and unfortunately, a possible recession.
The economic data releases in March were down significantly, but they have only started to reflect the new economic reality imposed by the measures needed to combat the coronavirus. While some of the indicators came in above forecast, the results were due to sharply lowered expectations rather than real outperformance. Almost all economic indicators now sit at a red light level, and the remainder will likely get there within the next month. There is hope for a potential swift economic recovery once virus-related stay-at-home orders are lifted, but there is no doubt that we are currently experiencing a period of extreme economic stress. First up, the service sector. This measure of service sector's confidence fell from 57.3 in February to 52.5 in March, which beat expectations for a drop to 43. This is a diffusion index, which values above 50 indicate expansion and values below indicate contraction. So this result demonstrates surprising resilience from the service sector during the month. Despite this better than anticipated result, future surveys are expected to show significantly lower confidence levels as businesses will be coping with the massive drop in consumer demand created by the government's measures to combat the spread of the coronavirus. Given the sharp fall in confidence we saw last month, as well as the likelihood for further declines in business continue to deal with the shutdown, we are downgrading this indicator to a red light. March's report was disappointing. As 701,000 jobs were lost during this month, this was a significantly higher than the decline of 100,000 that economists expected. This result marks the first month with net job losses since 2010, breaking an extraordinary streak of monthly job gains over that period. This disappointing result brought the year-over-year rate of change to the lowest levels since November 2010, when we were finally beginning to see the jobs market show signs of sustainable recovery from the Great Recession. This grim report was made worse by the fact that it undercuts the true damage done to the economy during the month. This report covered only the first 2 weeks of March, and the pace of layoffs increased dramatically during the second half of the month. April's unemployment report is expected to show significantly more job losses and a climbing unemployment rate. Given the sharp decline in March and the significant decline we will see in April, we have moved this indicator down to a red light. These are the same numbers as the previous chart, but on a month-to-month basis, which can provide a better short-term signal. The pace of month-to-month job growth dropped sharply in March, falling by the fastest monthly rate since April of 2009. The headline jobs figure came in worse than expected, and the underlying data was negative as well. The unemployment rate increased from 3.5% in February to 4.4% in March, which was worse than economists estimated for a rise of 3.8%. This disappointing result indicates that business owners began laying off employees earlier in the month than previously thought. All eyes will be on April's unemployment report, while economists expect to see the already booked layoffs from the March and April take the unemployment rate up to 7.7%. Given the disruption to the job market in March and the anticipated future weakness, we have moved the signal down to a red light. The yield curve. After spending the fourth quarter uninverted, the yield curve reinverted in January, remained inverted through February, and uninverted again in March. This uninversion was driven by sharp drop in short-term rates, which in turn has caused by the Fed's decision to cut the federal funds rate to effectively 0% during the month. The yield on the 3-month Treasury fell from 1.13% at the start of the month down to 0.11% by the end of the month. The yield of the 10-year Treasury also fell as investors fled to the relatively safety of Treasury bonds. However, this was a more muted drop, falling from 1.1% down to 0.7% during the month, leaving the gap at 59 bips. While an inversion is a good signal of a pending recession, it is when the gap subsequently widens to 75 bips or more that a recession becomes imminent. And that is what has just about happened. With the spread continuing to widen and the approaching the critical level, we are taking this indicator to a red light. In conjunction with other monetary and fiscal policy actions, the widening clearly indicates rising risk. Consumer confidence. Consumer confidence fell from a upwardly revised 132.6 in February to 120 in March. The result, which beat expectations for a decline to 110, brought the index to its lowest level since July of 2017. On a year-over-year basis, the index fell by 3.4% in March. The sub-index measuring consumer concerns about the future cratered from 108.1 in February to 88.2 in March. The measure of current conditions experienced a much smaller decline from 169.3 in February to 167.7 in March. The surprising strength in the present situation index indicates that there are still plenty of room for headline figures to fall in the upcoming months. Consumer confidence will be a key economic indicator going forward, given the relationship between confidence and spending. While the decline in March was disappointing, we're leaving this indicator at a yellow for now due to the better than expected results. But a downgrade to red is likely if we see further declines in April. Indeed, such downgrades are very likely, as the University of Michigan survey just showed a significant decrease. While some of the March releases came in better than expected, those results did not take into account the most recent and much worse data. The overall picture of an economy that is turning down sharply from the headwinds created by current anti-coronavirus measures. This is a swift change to the first 2 months of the year, where we saw largely improving economic data. These early results have helped cushion some of the recent fall. For example, the sharp drop in non-manufacturing index would look even worse if it had some form of a lower base and brought the index down below 50. Nonetheless, the downturn is now underway. Ultimately, this was a month that showed quite clearly the impact that a large external shock can have on the economy, both on a monthly and year-over-year basis. The reports point toward an economy that stands on the brink of a recession, if it's not already there. Given the weakening economic fundamentals during the month and the anticipation for further pressure from the measures to combat the coronavirus, we are bringing the overall risk level to a red light for the economy as a whole. This is not the time to panic, but to measure your risk. 3 things you can do with your investment portfolio. Number 1, compare your portfolio risk versus your personal risk tolerance. We have an analysis called a Riskalyze that is available to you free of charge. Click the link below, fill it out, import your portfolio into the Riskalyze, and it will tell you if your risk tolerance is in line with the risk your portfolio is taking. Number 2, what is your time frame? Take a look at when you're going to need your money, how you're going to need it, and measure out, are you in risk of actually not having enough time to recover from the recent fall down in the market? Number 3, and most importantly, stay diversified. Make sure you're building a diversified portfolio of stocks and bonds and cash. This is the time where risk management is truly key. If you need help on this, please feel free to reach out to me, Trent Grinkmeyer. You can click my information and reach out to me via email or a phone call. I am here to help you. So 3 things you can do from a personal standpoint at your home. Number 1, make sure you have adequate cash reserves. If you're a single family income household, we recommend you have 10 months worth of income needs. Just in case you get laid off or there's a cut in hours, having that cash reserve buys you time to recover and get yourself back in the position you need to be in. If you're a double income household, we recommend at least 3 months worth of income needs in cash. Number 2, review your future retirement. Reviewing your future retirement income needs is very important. Depending on how close you are to retirement, the amount of risk you're taking in your portfolio, the amount of time you will need to recover from any downside you may have experienced in your portfolio is key. So review your future retirement income needs. And number 3, reduce debt. If you're carrying a high debt to income ratio, create a plan to pay off debt so that you can manage that debt as we go through this recessionary environment.
If you need help and guidance, please do not hesitate to reach out to me. Grinkmeyer Leonard Financial is here for you, here to help you answer those questions and those concerns and help you build a game plan. After this portion of the video, you'll see my contact information and how to set up a time to meet with me or talk via phone or video, which has become the norm, right? I look forward to talking to you soon. Be healthy and be safe.